Thank you for joining us today. Our topic this month is on investing in municipal bonds. This is a topic we get asked about frequently and a topic that seems like it should be straightforward, but actually has some pretty complicated features and calculations that we find leave a lot of investors with a misunderstanding of whether or not municipal bonds are a good investment for them. And so we thought this is a perfect example of a topic for our webinars where we can spend a little more time to look through the specifics of a topic in detail. There's going to be two parts to this webinar. At the start, we'll just look at some basic features of municipal bonds. And in the second part, we'll look through a couple of examples on how to determine if a municipal bond is really a good investment for you. Of course, the primary feature of municipal bonds is that they can be completely tax-free, or the interest from them can be completely tax-free for you. This can mean free of federal taxes along with state taxes and even local taxes if that applies to you. Municipal bonds may be exempt from federal income tax. I put maybe here just as a disclaimer, really, because there are some municipal bonds that are still taxed federally. However, your custodian should make it very obvious to you. For all examples in this webinar, we're going to assume that the municipal bonds are exempt from federal taxes, just for simplicity. And then also the interest on these bonds might be exempt from state income tax as well. To qualify for this benefit, you usually have to purchase a municipal bond within your state. And that means, for example, if you live in Iowa and you want a municipal bond that will not be taxed in Iowa, you need to buy a municipal bond that was issued somewhere in Iowa. And so again, as a disclaimer, there's some fine print here. Not every single municipal bond issued within a state is exempt from the state's income taxes. So just be sure your custodian or you are verifying that any bonds you purchase do qualify for that exception or exemption. From our experience working with Schwab, this is very clear, but just be sure you're checking the fine print before investing. And so, but what should you know before making an investment into municipal bonds? Because at first glance here, everyone always seems to think that, this investment's completely tax-free, so it must be a great thing to invest in, right? And that's what we really want to cover in this webinar today, because as we're going to find out, it's usually not so simple. And just for an example of how municipal bond interest can trip up people in their tax planning, while the income from municipal bonds is potentially not taxed at the federal or state level, it does still impact part of your tax returns. And we're showing here on the right Form 1040 for your annual tax return. And notice that the interest from municipal bonds is still reported to the IRS. Why is that? Well, the income from municipal bonds is factored into several different calculations for what's called your modified adjusted gross income. And so it does impact things like how much your Social Security benefits are taxed, how much you pay for Medicare. This is the IRMA, or the monthly surcharge on your Medicare that's based on your income. And it can impact the tax credits you qualify for if you get your health insurance on the government exchanges. And so while these bonds are not taxed at the federal income level, these examples show how the interest from these bonds can still significantly impact the net tax amount that you pay in any given year. And then besides the interest, any gains in principal on the investments in municipal bonds is also taxed. This occurs when you purchase a bond at a price below what's called its par value, or the value that the bond will be redeemed at. And just for example, if a bond would pay you $100 when it matures, but you buy it at $95, that $5 difference will be taxed. And this is very relevant right now because a lot of these municipal bonds have had significant declines in their price as interest rates have risen. So if you buy these bonds now and hold until maturity, or just sell if they happen to increase in value, if interest rates decline again, that gain in your principal will be taxed. And how that increase in value is taxed is dependent on a certain formula called the de minimis rule, which we're going to look at a little bit later. But just to start here, Let's say, knowing all this, you still think municipal bonds are a great investment for you. So, stepping back, how do you actually go about investing in municipal bonds? And there's a lot of different ways. Generally, the method thought of as the most simple and perhaps the most common is just buying a set of individual bonds. This means going in your brokerage account or going to a broker and saying, I want to buy a University of Iowa municipal bond. And there are big firms that invest this way for their clients, and a lot of individual, just kind of DIY investors as well that invest this way. And so we frequently see portfolios full of individual municipal bonds like this. But we think investing this way has a few potential drawbacks. And first of all, like with any other type of bond, it can be difficult to diversify unless you're investing a really large amount of money. For example, this image on the right is some details we see in Schwab if we go in to buy an individual bond for a client. This is a bond from Iowa State University, and you can see on the right, the only offer right now to purchase this bond is from a seller that has a minimum of 15 bonds available for sale. This would be a minimum purchase of $15,000. And so if all you have is, say, $50,000 to invest in municipal bonds, this could be, too big of a portion of your investment to be comfortable with in one single security. Another risk is that these bonds can be very illiquid and thinly traded. Here we're looking at some details of a different Iowa State University bond, and you can see here over the last 6 months, there's been only 7 days where this bond actually was traded. And so if you own this bond and we're looking to sell this bond before it matures, it could take a while to be able to sell it. And not only that, but of course, there's not that many people looking to buy these at any given time. And so you might have to take a lower price than what you want to sell it for just to be able to sell it. And then lastly, if you're not comfortable looking through the thousands and thousands of individual bonds that are available and selecting your own, you'll have to go through a broker to help. And they can charge pretty significant commissions on any individual municipal bond transaction. You can find these fee disclosures for any broker out there. I'm showing here one from Edward Jones, and there's just a caveat that this can change at any time, but this fee exists for every other broker out there. And from the many brokers I looked at, just as I was tracking this down, the fees seem to be pretty much in line. There weren't a lot that were much higher or much lower. And so what is the fee, for example, here? And see, Edward Jones is disclosing that they charge a 2% commission to purchase these municipal bonds for you. And then they'll also charge a 0.75% commission to sell. And so just under 3% round trip fee. And that's a pretty significant fee when we're talking about municipal bonds that generally have pretty low yields. Just for example, that Iowa State University bond we looked at in the previous slide, this fee would be more than 1 year of interest that you would get from owning that bond. And so this unfortunately is also one of the reasons why these municipal bonds just are so popular in people's portfolios. And that's that they're relatively easy to sell, right? Everyone likes the idea of tax-free income. And brokers really like to sell them because they're very well compensated to sell these to you. And so for these reasons, we think for a lot of people, it makes sense to use something like a mutual fund or an ETF to invest in municipal bonds instead of buying individual bonds. And we think this is a very good choice for most investors, but there are still some pros and cons to be aware of. Using ETFs or mutual funds in general make it very easy to diversify your investments. You can buy one fund that's going to hold hundreds or thousands of different individual bonds, giving you a very easy way to diversify. And they're also very easy to buy and sell, unlike individual bonds. These are, generally very liquid. You can purchase in a matter of seconds at a known price from just about any brokerage out there. But there still are a few things to consider. First, it can be difficult to receive interest tax-free from your state. Remember, you have to purchase a municipal bond issued by your state to be exempt from state income tax on these bonds. So if a municipal bond fund buys a New York bond, and I live in Iowa, I will still be taxed by Iowa for the interest from that New York municipal bond. And when you use a bond fund, you don't have the control of which bonds they're purchasing. And so you'll likely end up still owning a lot of out-of-state bonds and still paying state income tax. And then lastly, you pay for this convenience. Every ETF or mutual fund is going to have some kind of fee or expense. This can vary widely, as we'll see in a minute, but it is an added cost. And just to look at an example, here we're looking at a municipal bond fund from iShares. This is the largest municipal bond fund out there today with about $35 billion in assets. And you'll see here, I highlighted a couple items in red. This fund has a very low expense ratio, or this is your annual fee for investing in the fund, of 0.07%. And this one fund has more than 2,000 individual municipal bonds as holdings. And so an investment in this fund is diversifying you very well for a very low cost. But even in this very good fund, there are still some downsides. And for example, me as an Iowa resident will not receive much of a state tax exemption at all. The image here is showing the breakdown of the investments that this fund makes based on different states. So you can see at the top of the list here, New York municipal bonds make up about 21% of the fund's holdings. California bonds make up just under 19%. And if you'd go down this list here, you would eventually see that Iowa bonds make up about 0.13% of the investments in this fund. And so as an Iowa resident, only about 0.1% of the income I get from this fund will be exempt from state taxes. Most of the income I get, I'll still be paying Iowa state taxes on. And so now funds do exist that invest solely in one state's municipal bond, and so that investors get that entire income tax exempt from their state. These are easier to find for bigger states like New York or California, but they do not exist at all for many states. For example, there is no Iowa State Municipal Bond Fund. And as soon as you get outside of large bond funds, run for these really big states, expenses start to creep up. And so just shown here is an example of an Ohio Municipal Bond Fund managed by Nuveen, which is a company owned by TIAA. It invests exclusively in Ohio municipal bonds. So if you're an Ohio resident, you might see this as a very attractive option because now these bonds are getting you both federal and state tax-exempt interest. But the problem is that as these funds get more specific, their fees also increase. So shown here, you can see that this fund has an expense ratio or the annual fee of 0.56%. So about 8 times higher than that iShares fund that we looked at on the previous slide. And what's interesting is that although at the surface this bond should be very beneficial to Ohio residents, the fees that are charged actually make it not that great of an option. And so just for example of the impact that these added fees have, consider as an example a $10,000 investment from an Ohio resident, and we'll compare the net return that this investor has from using that iShares fund we looked at, that's MUB as its ticker symbol, or compare that to the Nuveen Ohio Municipal Bond Fund that we just looked at, that's ticker symbol NHOHX. And just as an assumption, let's say that these funds have the same yield of 3.5%, and let's say the investor is in Ohio's highest tax bracket, which is just about 4%. When we look at that $10,000 investment, each fund is going to pay that 3.5% or $350 per year in gross interest. With the iShares fund, you pay a significant lower fee, just $7 in this case, compared to $56 for the Ohio fund. And however, you do pay Iowa state tax on on that interest, which would amount to about $14 in taxes in this case. So this fee or this tax combined with the $7 fee means that of that $350 in interest this hypothetical Ohio investor is getting, they're going to have about a $329 net, after tax, after fee return. That $10,000 invested in the Nuveen Ohio Municipal Bond Fund has no taxes at all for this Ohio resident, but that much higher fee ends up offsetting any gains in the tax benefits from this fund. And you'll see this investor is left with just about $294 net. And so even though at its surface, it seems like this fund is made for an Ohio investor like this, it ends up not being that much beneficial compared to just a low-cost alternative. And so now, knowing this information and some details to consider, we wanted to run through an example or two just to show you some real numbers about how to evaluate when a municipal bond actually makes sense for you. And the biggest consideration besides fees is determining what's called a tax equivalent yield. And this has to actually be a calculation because there's 4 different types of bond investments, and each one has a little bit different tax treatment. And so what we're trying to do here is equate, a yield with a certain investment compared to the yield of another one after taxes are applied. And so just as a quick overview, you might have corporate bonds. So these are bonds from big companies that you've heard of, Apple, Amazon, Microsoft, and so on. Also lumped in here is bank CDs or certificate of deposit, since they're taxed the same way. The interest from these investments is subject to federal and state income taxes. And then you have treasury bonds. These are bonds issued by the US government. They are exempt from state tax, but you will still pay federal tax on the interest that you receive. Next, you could buy an out-of-state municipal bond. This would be, if I'm an Iowa resident, I buy a California municipal bond. This would not be subject to federal tax, so you still get a nice tax exemption there, but it would still be subject to your state tax rate. And then lastly, you have in-state municipal bond. So again, as an Iowa resident, this is me just buying, for example, an Iowa State University municipal bond and getting the full federal and state tax exemption on that interest. And what we see when we look at the interest rates for all these types of bonds is that municipal bonds have much lower interest rates than some of these other options. And what this means is that there's a tax rate where municipal bonds might make sense, and there's a tax rate where they might not make any sense based on these lower yields. I've included here the interest rates of examples of these bonds just as they were last week. There's a general disclaimer here that these numbers change every day and are just an example of one bond in each of these categories. It's not a recommendation to invest in any of these specifically, and these are just used as examples. But these rates are based on real data. I matched up bonds that each mature in about 5 years and bonds that had the same credit rating from Moody's. And so with the exception of the treasury bond, of course, which is guaranteed by the government and generally considered much safer than these other options here, these should be a pretty similar comparison. And so if you were considering an investment in any of these bonds, this is what you'd want to look at. What are the interest rates for each of these bonds? What are my tax rates that this interest is going to be subject to? And then figure out what makes most sense. And so if we again assume a $10,000 investment for a resident of Iowa that is in Iowa's 6% tax bracket and then also in the 22% federal tax bracket, here's how this interest ends up getting taxed and what your net return ends up being. For the corporate bond or bank CD, that you'll receive about $548 in interest. That gets federal tax applied, which would be about $120, and Iowa state tax would be about $33. You're left with $395 or so after tax. For the treasury bond, it's a little bit lower, about $357 net after tax. The out-of-state municipal bond would leave you with a little less still, about $322. And then finally, the in-state municipal bond leaves you with about $263. And so the most important thing to realize here is that these numbers all look a little bit different to everyone. If we assume that this person is in the 35% federal tax bracket and lives in California and is subject to their highest tax rate, which is about 13%, these numbers would very quickly start to favor municipal bonds. And that's pretty common. Very high income households do find that municipal bonds can make a lot of sense, but it's hardly universal that these are the best investment for everyone. As you can see, most people actually would get a higher net return from some of these investments that are taxed more. And then as a final point here, there's much more to this analysis than just interest rates. I had mentioned in an earlier slide that gains in principal on municipal bonds are taxed as well. And that can be taxed at either a capital gains tax rate, which is 15% for many people, or 20% for very high income households, or this gain can be taxed as at income tax rates too, which are higher, can be as high as 37%. And so whether your bond is taxed at capital gains rates or income tax rates is dependent on something called the de minimis rule. And I'm not going to cover it in a lot of detail here. I really just want to raise some awareness to show you another important factor, in this decision of investing in municipal bonds. It's a pretty simple formula. You plug in some basic metrics of the bond, and depending on the answer, it will tell you whether or not the principal gain from a municipal bond investment is taxed as either capital gains or income. And then shown on the right here is the details of that Iowa State University bond that we looked at in the previous example. You can see here it has a current yield of 2.63%. And what's important for this de minimis rule is the price of the bond. And this bond is a par value of 100 and a current price of just under 95. This means that an investor that purchases this bond for about $95 today and receives about $100 at maturity plus all the interest over the years as well. And so that $5 in difference, or about $500 per $10,000 investment, will be taxed at federal and potentially state income tax rates. And so we said in the past slide that municipal bonds tend to make the most sense for those with very high incomes and therefore very high tax rates. And so if we assume that the owner of this bond is in the tax rate of 32 or 35% federal tax rate plus say a 6% tax rate, you're seeing here they're paying close to 40% of this gain back in taxes. And this comes as a big surprise for a lot of municipal bond investors because they just heard that municipal bonds are tax-free and think that everything they're going to get from this investment is tax-free, and it ends up potentially causing a big tax bill. And so hopefully this served just as a good look at some details you need to consider before investing in municipal bonds. And I hope the key takeaways are pretty clear. While municipal bonds do make sense for some, it is not a universal good fit for all investors. Before you invest, you have to make sure that the tax benefit of municipal bonds is actually worth it for you. Do not get into a lower return investment just because it's tax-free. And also a really important point is that the tax benefit of municipal bonds does not exist within qualified retirement accounts. So that's 401ks, IRAs, Roth IRAs. Interest earned on investments within these accounts is not taxed anyway. So most municipal bonds have no added benefit of being within an IRA. And so that alone makes these not great investments for a lot of people, since a good majority of people have most of their wealth tied up in retirement accounts, and they just quite honestly do not have a need for municipal bonds. So that's all we had today. Thanks as always for listening. If you have any questions on municipal bonds or any other topics related to your financial plan, please don't hesitate to ask. And finally, as a reminder, we do most of these webinars from topics that clients suggest or just ask us about. And so if there's a question on your mind that you'd like to see us cover in more detail like this, please don't hesitate to let us know. Thank you.